Good afternoon, and thank you for joining us for today's web seminar. I am Karen Weiskopf, the Director of Marketing at First Long Island Investors, and I'm joined today by Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, Edward Palleschi, who's a Senior Vice President, Wealth Management, and a member of our Investment Committee, and Brian Gamble, Vice President, Wealth Management, and also a member of our Investment Committee. Before we begin, I would like to take care of a few logistical items. First, all participants are currently in listen-only mode. Second, after the team delivers the presentation, we will have some time to answer any questions from the audience, as well as questions that we received in advance. In addition to our presenters, we have a few additional members of the Investment Committee here for that portion of the session. Please feel free to submit questions at any time. You do not need to wait until the end. On your screen, there's a dialog box labeled Questions. That's where you can type your questions and our team will see them. At this point, everyone should see a slide with the heading Today's Speakers. If you don't, please type something in the chat area and we will do our best to help troubleshoot. And finally, our General Counsel has asked that I remind you that today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. I now hand it over to Bob.
Thank you, Karen. And we'd like to thank all of our listeners in this webinar this afternoon. We hope you all had a great summer. And now that Labor Day has come and gone, it's time to get back to work and focus on the investing future. As you can see from our next slide, there's a quote that we included in our last quarterly letter that we think is something that one should consider over the long term. And that is, fear keeps you from making as much money as you ought to. And that's a quote from Jesse Livermore, also known as the Great Bear on Wall Street. And the reason why we mention this quote, or utilize it, is that fear sometimes leads to wrong decisions by investors. It can lead to market timing, which is hard to do. It can lead to having too much cash not invested. And in this era of financial repression, as you know, cash earns very little. So over the long term, we don't think that's a good thing to do. Fear and greed drive the markets, and we're going to be focusing on some of the reasons that investors are fearful today. If you turn to the next slide, you'll see that we have an agenda that focuses on the U.S. economy in summary, the state of the current markets, particularly the equity markets and bond markets, drivers of volatility and investor concern, of which there are quite a few drivers of volatility, which we will discuss in detail. Our approach to investing for the balance of 2016 and beyond. And then, as Karen stated, we will have a period of time for questions and answers, and we hope that we have some good questions, and we'll try and give you the most reasonable answers that we can. In looking at the U.S. economy, we have 4 charts on this page which paint a picture that is reasonable in terms of the economy and important in terms of the investment advice that we give you. If you look at the chart on the upper left-hand side of the page, real gross domestic product year-over-year change, you'll see that the average GDP growth since the mid-1960s has been 2.9%. And that sort of GDP growth fuels corporate earnings. It creates revenues for the U.S. Treasury that permits us to run the government. The issue is that since the great, what we call decession, which is somewhere between a depression and a recession that occurred in the 2008 and 9 period, if you look at the chart, you can see the spike down in terms of GDP negative growth at that time. We have rebounded in a sort of steady fashion, but at a 2.2% average GDP growth, which is below the long-term average, and certainly well below any average achieved after a recession. And as you know, this GDP growth has been achieved with a monetary policy on steroids, or the period of financial repression that I mentioned earlier, where interest rates, as you know, are basically yielding nothing. And that hurts bonds, and it hurts certainly money market funds. And what's lacking in terms of getting this growth to be a bit more robust, the most recent quarterly period produced was a 1.2 year-to-date GDP growth, which is certainly not acceptable. is the fact that there is very little, if any, fiscal policy growth. So what we're hoping for after this election cycle, irrespective of who gets elected, that there is greater consensus, compromise, such that we have some fiscal policy growth to go along with the accommodative monetary policy. But this chart in particular shows that our economy is growing. We are not in recession. We do not project that we will be in recession in 2016, or for that matter, 2017. If you look at the chart to the right of that, all employees, total private industries, you'll see a solid and steady employment growth, which is helping our economy. We lost almost 9 million jobs during the Great Recession, as we have coined it, and we've gained 15 million jobs since then. A solid and steady pace of job growth that you read about once a month or hear about once a month, where job gains have averaged at least 150,000. The only problem with that job growth, which has been solid and steady, is it is primarily lower paying jobs. And that's why there's a call for infrastructure growth and trying to bring back certain manufacturing jobs to the U.S. so that the new jobs that are created pay more. But despite this, we've had solid and steady job growth, which helps the consumer. And as you may know, the consumer is 70% of the economy. So this is a very positive chart. If you look at the next chart on the lower left-hand side of the page, University of Michigan Consumer Sentiment Index, this also has rebounded quite significantly since the lows of 2008 and beginning of 2009. This is also very encouraging because, as I mentioned a few seconds ago, the consumer is 70% of the U.S. economy. So the health of the consumer, the balance sheet of the consumer is critically important, and confidence is critically important in terms of the velocity of how they spend. And consumers are spending at a reasonable clip. If you then look at the last chart on the page, the MBA Refi Index versus the Freddie Mac 30-year fixed rate, it's sort of a bunch of fancy words describing that 30-year mortgage now that many Americans are subject to has really reached a very low point, almost the lowest point in history for mortgages. And that's very helpful in creating some refinancings that are going on, which helps the financial sector and helps the balance sheets of consumers who are in the process of refinancing their homes. So this is also a healthy chart, but it reflects the fact that interest rates are very low. And you'll see from later discussion that rates we think will remain low, will go higher in a modest, slow growth fashion. And this refinance and housing activity should continue. So when you look at the U.S. economy in summary from these four charts, you'll see it's in reasonable shape, but not quite as good as it really should be. We believe that the truer GDP growth should be closer to 3%, especially given the low level of interest rates. But this is a positive, and this should allay some fears that our economy is going into recession, because it's not, in our opinion. The next page is one that concerns all investors, and we have written about it over the past year and a half, and that is that volatility continues. Given the proliferation of information on a global basis, given the events that can affect volatility, which we will describe in greater detail in a few moments, we track volatility because it's volatility that scares investors. And that volatility does not necessarily reflect the underlying strength of businesses that we invest in. It's more emotional. And this year has been a good example of a year with erratic volatility. It's been erratic thus far this year. If you recall, the first 19 trading days in 2016, 18 of them had a greater than 1% range. So all of a sudden, between Christmas and New Year, nothing much changed. But as soon as January 2nd came along, we experienced a period of significant equity market volatility, as well as oil price volatility. And we suffered through about 6 weeks of a severe downturn, again, not caused by any economic factors that we can highlight, but it scared the daylights out of a lot of investors, and certainly didn't make us happy here at First Long Island Investors. And then the markets rallied, came back, only to experience another period of volatility surrounding the Brexit, which we'll discuss a little bit later, and the market went down dramatically for a period of a day or two. And most recently, Friday of this past week, and today, and yesterday, we've hit some more volatility in the market. And we expect that when you look at the drivers of volatility, that volatility will continue. But again, as investors, we have no choice but to endure that volatility and expect better gains over the long term without being intimidated by the volatility. Turn to the next page. You'll see that there are a certain number of drivers of volatility that we're really focusing on. One this year has been energy market turmoil, where energy plunged from $100 to a little bit more than $20 a barrel, and now it's rallied. But that turmoil in the energy market is a driver of volatility. Continued slowdown of the Chinese economy, which was inevitable as it got larger, has also been a driver of volatility. The United Kingdom's decision to exit the EU also caused some volatility and actually messed up the bookies who had the wrong side of that bet. The timing of the Federal Reserve rate change, we've been waiting for it all year. Will it come in September? Will it come in December? Will it not come at all this year? That's also a driver of volatility as the Fed speak goes from day to day with different Fed presidents who are voting and non-voting on what will happen with the rate change. And of course, the upcoming presidential election, where not only is the presidency in play, but the Senate and House of Representatives is as well. That also will create some volatility. And with that, I'd like to turn it over to my partner, Brian, who will discuss some of these drivers of volatility.
Thank you, Bob. The first driver of volatility we're going to cover today is oil. So one of the bigger drivers of volatility is the price of oil over the last 2 years. As you can see in the chart on the left-hand side, oil declined by 72% from the peak in June 2014, the most recent trough in January of 2016. From that point, it has rebounded 48% year-to-date. The decline was mainly due to oversupply, as global production has grown faster than consumption, as seen in the table in the upper right, where you also notice that U.S. production has grown significantly. And notably, the U.S. is now the swing producer globally within the world. OPEC has not maintained control over the price of oil as it has historically, because the Saudis are using the price of oil as a political tool to hurt the economies of Russia and Iran, as well as U.S. producers by not capping production quotas. These economies require a significantly higher price of oil to balance their budgets. In response to this oversupply, production growth has slowed elsewhere. The U.S. rig count has fallen significantly due to the relatively short amount of time it takes to shut in U.S. shale production as these inventories have grown. This has caused a slowdown in U.S. production growth. The oversupply is expected to continue through 2016 as more production continues to be shut in, while projections for 2017 had fluctuated between a small supply shortfall and most recently continued oversupply next year. Should the price of oil continue to rise, more production would begin to come back online, which would potentially create a supply imbalance again and effectively serve to put a ceiling on oil prices over the near term. This will continue to remain a source of volatility. Another driver of volatility continues to be the Chinese economy and stock market, although not a lot has changed since our last webinar. Chinese GDP has been on a decelerating trend since the most recent peak in 2010. Although more recently it appears to be bottoming and data is pointing towards a modest reacceleration. The economy is transitioning from an investment-led industrial economy to a consumption and service-driven economy, which has been bumpy. This transition is not yet complete and will continue to be a source of volatility. However, the second largest economy, growing between 4 and 5%, or possibly more, is still constructive. The Chinese stock market has appeared to have bottomed and started to recover following last year's volatility, which you can see in the bottom left-hand corner. Putting all this in perspective, China makes up a relatively small percentage of U.S. GDP, less than 1% of the nominal GDP. The large swings in the market as a result of news out of China seem to be overdone. When looking at these statistics, and are most likely driven by fear and emotion. Headline news out of China will continue to be a driver of volatility as the economy continues to transition. The third driver of volatility we're going to discuss is more recently the vote in the UK to exit the European Union. In June 2016, the United Kingdom voted to leave the European Union in a surprising historic referendum vote that caused significant volatility in financial markets over the days immediately following. The U.S. market bounced back quickly, however, recovering the lost ground shortly after the end of the second quarter. While it will take some time for the true impact of the vote to be understood and felt, it appears at this point to have had very little impact so far. In fact, Europe appears to be strengthening a bit despite the turmoil, according to recent data. As you can see from the chart on the right, and similar to the chart we showed on China, the impact on U.S. GDP appears to be minimal, as the United Kingdom makes up only 0.3% of U.S. nominal GDP. I'll now turn it over to Edward Palleschi to cover some additional drivers of volatility, as well as some positive aspects we see today.
Thank you, Brian. Certainly, the timing of the Federal Reserve rate change has caused a great deal of volatility. This volatility is in part caused by a real divide between market expectations of economic growth and inflation and the expectations of the Federal Reserve officials on economic growth and inflation. I would direct you to the blue line on the bottom of the chart, which is the Fed funds rate, which is indeed remains near historic lows. But I want to point out the divide I was referring to in terms of the red dotted line, which is the FOMC year-end estimates of around 1.6%, and the market expectations as of 9/16/16, which are in the gray dotted line. You could see there's a great divide of about 100 basis points differential. You'll recall that the Fed at one point was discussing 4 rate hikes at the end of this 2015. They've certainly lowered those expectations, and it's due to data-dependent issues as well as event-dependent issues. One of the main data-dependent issues that they've come up against is that the Fed believes the inflation rate in the U.S. will return to its target rate of around 2%. However, investors, particularly within the bond market, aren't confident that inflation will return to this level anytime soon. Case in point, in August, inflationary expectations averaged around 1.5%, the same as the average for the past 8 months of this year. And there's further doubt cast with regard to the economy or the pace of the recovery within the economy. Certainly, it's expanding, but at a moderate pace, and it's certainly not overheating. The event-dependent issues range from, as we've talked about, China's economy slowing down, a soft job data in this past spring, and certainly Brexit. At the time when Brexit occurred, there were the so-called market experts who were talking about there wouldn't be a rate hike in 17 or probably best case 2018. And I would just point out in our last quarterly letter, we stated that we believe it's premature to completely rule out a potential rate hike for later this year. Earliest likelihood was probably December, as we stated. So in that sense, I think we're going to be ahead of the curve. I don't think at next week's meetings, I don't think there'll be a rate hike. I think December is certainly on the table. The Fed is going to stay accommodative. The pace is much more important than when the first rate hike will occur. But certainly expectations will come down, I think, as per the Fed funds rate expectations next week. They certainly will be lower. Next up, I want to talk about the last driver of volatility, and that's the upcoming presidential election. As you can see, the graph states in year 4 of a presidential cycle, here are the average quarterly S&P returns. And certainly on a historical basis, it's been positive, and in the fourth quarter has been the best return thus far. In 2016, for the first quarter, the total return for the S&P 500 index is around 1.4%. For the second quarter of this year, it's up 2.5%. And as of Friday, September 9th, we were up about 1.8%. So it bodes well that the fourth quarter will be up there as well in terms of a positive quarter. it doesn't hurt that November, December are part of that fourth quarter, and historically they've been the best performing months of the year for the stock market. But there indeed are, as Bob alluded to, many uncertainties surrounding the upcoming U.S. presidential election. The concern for many investors are what are the political and economic policies that will be put in place once the election is decided, and how is that going to impact and shape U.S. and global economic growth going forward. And this is a good opportunity for me to point out that an FLI invite will be going out for our next Thought Leadership Series breakfast discussion, which is November 2nd, where the featured speaker would be Mina Bose, and the topic is who wins the White House in 2016 and what happens next. Mina is the Dean for Public Policy and Public Service Programs at Hofstra University, and she will then provide a much more in-depth discussion on the impact of this election and where we will be going forward. So invitations will be going out this week, so please keep on the lookout for that, and we hope to see you there. And as Brian alluded to, let's talk about corporations and the earnings growth. And I think there's something worth clearing up here because earnings growth is indeed solid. And as you can see by the chart, the first chart up top, you can see the quarterly operating earnings. There's been a fundamental trend here that we're in profits, which has been positive, and with the majority of sectors reporting higher earnings. I think it's important to understand, as the second chart below points out, it's important to understand that the earnings contraction of the past 2 years has been narrowly based in two sectors, energy and materials. And you can see the corporate earnings in energy and materials has been declining, while the corporate earnings in non-energy and material profits has been on a slight upswing. The plunge in energy and commodity prices has led to a massive decline in profits. If you exclude the energy and materials sector profits, they actually increased by 5% in the second quarter of this year. So that's worth pointing out. And obviously, another positive is the U.S. dollar not having a negative impact on earnings. You could see a weaker dollar has a year-over-year change here in the first and second quarter of 2016. And why that is important is basically a rising dollar reduces the level of profits when local currency sales are converted to dollars. And that's a key factor there that hasn't had as material of an impact as, say, previous quarters. Next up is the S&P year-over-year growth versus the GDP year-over-year growth, and I think this is important to point out. You can see the gray bar chart is a recession, and you can see the most recent recession we had was 2008, 2009. I think the key here is looking at the S&P growth and looking at which is the red line, and the blue line being the GDP growth year-over-year. We don't see a recession in the near term based on the economic data that we've researched and studied. Therefore, we don't foresee a decline in the S&P index as being likely, given, again, the economic environment we currently are faced with and current evaluations. But as Bob alluded to, the driver of GDP growth is the consumer, and the middle class is a key component of that in terms of them seeing income growth acceleration. So that's an important component of seeing continued year-over-year growth. As Bob alluded to, the consumer is 70% of GDP. Next up, I want to talk about valuations, which we just alluded to, and that's basically PEs are indeed slightly elevated at this point in time. If you take a look at the average S&P 500 PE for the next 12 months by consumer price index, and the tranche I want you to focus on is between 0 and 2%. Historically, when the consumer price index is between 0 and 2%, it's currently at 1.1%. The PE is around 15 times. Currently, the PE for 2017 is 16.7 times, as you can see there as of 6/30. This is important to point out that indeed PEs are slightly elevated, but we always take valuation into consideration. with regard to our stock selection and believe further appreciation will be predicated on earnings growth. So that's the key factors that we look at. And I think now, taking into account what we've already discussed, I want to now turn it over to Bob, where he's going to provide some additional insights on our approach to 2016 and beyond.
Thank you, Ed, and thank you, Brian. So we've discussed the drivers of volatility, which are a concern and will continue to be a concern, certainly through the election period and then the aftermath on what policy will be. We've looked at earnings that had been in a slight downtrend, particularly because of the collapse in certain commodity prices. But when you extract them out, as Ed pointed out, earnings are in a slight uptrend. And given the fact that the dollar is no longer the headwind that we expected, or it has been, we believe that S&P earnings will continue to trend up in a moderate or modest way. And the Fed increasing 25 basis points, if it should happen next week or in December or the beginning of 2017, really isn't a great concern to us because interest rates are at or near historical lows, and we don't believe that the Fed funds rate, even going up to 1%, will in any way deter economic growth. What we do need, as we've stated, is some fiscal policy growth, and we hope to get that. So putting that all together, along with fluctuating oil, which will go up and down, a bit like a yo-yo, as Brian pointed out, depending on supply-demand, how do we position all of our clients for the future, the balance of this year and beyond? And this page is a critically important chart that we show. It's our baskets of asset allocation that we customize for each of our clients depending on their specific needs and goals and how we view the marketplace that we invest in. So as you can see, it's typically our security investments, which are cash and fixed income. And our typical allocation right now is modest in this area with a focus on quality and shorter duration. With rates being as low as you will see, and as you know, we don't believe this is a good long-term investment at this point when on an after-tax, after-inflation basis, we're earning virtually nothing. If you move one basket to the right, you'll see our defensive strategies. And here we are overweight. Remember, our goal long-term is to preserve capital first and then grow it. We've got to do it in times like this by being somewhat defensive. So here we want to overweight our defensive strategies, which mitigate downside but permit us to participate in the upside. And we have three strategies in this basket that our clients are allocated to in some cases that give them that ability to mitigate the downside but yet participate in the upside and certainly produce a return greater than we can get from security investments. And then if you move one basket to the right, you'll see we have our traditional equities. Today we modestly underweight traditional equities, but we still believe there's a long-term opportunity there. And again, we have a bunch of different strategies that are diversified or focus on large cap growth companies or large cap value companies. We modestly underweight this at this point because we would prefer to overweight our defensive strategies where we can still get decent returns while we believe we're taking less risk. But in the traditional equity area, you should still have a significant allocation, although modestly underweight to what we typically do because we see long-term opportunity. And finally, in terms of private investments, we remain opportunistic. Whether it's real estate or mezzanine transaction or private equity, event-driven, real assets, collectibles, we continually look for opportunities in this area that are suitable for our clients. And not all are always suitable for these particular investments. If we turn to the next page, you'll see why we're underweighting fixed income. Right now, I did a quick calculation before. If we were to invest in a 10-year treasury and pay the current federal rate of tax on it, it would yield 96 basis points for 10 years worth of interest rate risk on an after-tax basis and before any fee. That's not very attractive when the inflation rate is probably, as we stated earlier, 1.1, 1.2, maybe trending up to 2%. In terms of the municipal bond, we have a chart here, or a line graph here, on the municipal general obligation AAA 5-year bond, which today is slightly less than 1% before fee. Again, 1% or slightly below 1%, again, is not keeping pace with the current inflation. So this is a concern to us, that to invest large sums of money in fixed income, even though in most cases, or almost all cases, we expect a return of that capital, it still will be a negative investment for our clients over time on an after-tax, after-inflation basis. So we're underrating fixed income at this point. Our overweight to our defensive basket, again, is designed to mitigate volatility, minimize downside capture, which basically means if the markets go down, we would anticipate that we will go down less in these strategies, but at the same time capture a significant portion of market appreciation, as we're doing in our dividend growth strategy this year. Here we have 3 examples of defensive strategies which give you the comfort of being somewhat cushioned against the downside while still providing the opportunity for reasonable appreciation. That would be our hedged growth strategies, our dividend growth strategies, and our multi-strategy hedged investments. All 3 are defensive. All 3 have less volatility than the traditional equity market, and we believe all 3 will mitigate volatility while still providing an opportunity to appreciate better than our security investments at this time. Now, one of those strategies I mentioned is our approach to owning dividend companies, and dividend-bearing companies that grow their dividends on an annual basis. And this chart is one that we've used before, and it shows the dividend aristocrats' outperformance over long periods of time over the S&P 500. And here we rely on steady cash flow, growth from increased dividends on an annual basis. So even if stock prices were to fluctuate with the drivers of volatility that we discussed earlier, what we bank on here, no pun intended, is that these companies are paying an above-average dividend to begin with. There's a tax preference on dividend under current law, and these dividends will increase on an annual basis, even if stock prices were to go down a bit and then come back. So we remain committed for an allocation of our clients' net worths to this defensive growth strategy, where we are relying on the culture of these companies to increase their dividends on an annual basis. Now, even though we're suggesting a modest underweight to traditional equities, we want to point something out that we think should be on the minds of virtually every investor. Somewhat higher interest rates does not mean an end to the bull market, but it will cause some volatility. And what we've attempted to show you here is over the last, I guess it's 17 years, the markets have endured increased interest rates in 6 periods of time. And in those 6 periods of time, 5 of them led to substantial increases in the S&P. So this demonstrates, at least historically, that markets can go up despite interest rates trending up, which is what we would expect over the next few years. A modest increase in Fed funds rate, a modest increase in bond rates, but at the same time, that should not stop the ability of the equity markets to appreciate. Our next slide demonstrates our recent commitment over the last, 8 years to an allocation to traditional equities with a domestic bias. This chart continues to show that domestic indices, the Russell 1000 Growth, the S&P, the Russell 1000 Value, have dramatically outperformed the international indices, EFA, or the All World ex-US, which includes emerging markets. And it's quite a difference. If you look at June 2016, you'll see that the domestic indices have trounced the developed world indices and the All World ex-US, including emerging markets. And I also want to point out here that we've done this because we think, and we've been correct thus far, that the U.S. economy has been stabler and more consistent than international economies, as well as our government, despite some of its flaws, still outshines anything overseas. And we have been relatively free from terror, whereas the international economies have been plagued with it. And therefore, our performance domestically has been better. And we are comfortable having a much lower than average allocation to internationally domiciled companies and rely on domestic companies that do a lot of business overseas to get our bite at the apple, so to speak, of emerging market growth, et cetera. There's one other interesting point on this page that I'd like to make, or an observation I'd like to make, and that is that notice investors can absorb downturns in the markets and end up with good returns if one is patient. There will never be a time when the markets go straight up. And this shows you this chart. If you look at the left-hand side of the chart from December 07, June, December 08, into June of 09, and then an acceleration in December of 09. Investors, we all absorbed a huge drop, upwards of in excess of 40%. And yet within a few years thereafter, we were back to a positive point and have grown since then, with the exception of the international markets that have not done nearly as well. So the point of this is we have been over-allocated to traditional equities with a domestic bias. We still believe that's the right way to go. We don't mind if we're a little late to the international party, so to speak, because of the safety and security that we get by investing in U.S. domiciled companies. And at the same time, if investors are worried about, is the market a little bit too high, there's some volatility caused by a bunch of factors that we have discussed, and you invest and the market goes down for a period of time, the point of this chart again shows that if you're patient, you invest in quality, and you have a good asset allocation, you can come back and make substantial monies over the long term, certainly much better than being in cash or in bonds that are yielding less than 1%. So this is an important chart. In summary, volatility is likely to come back. It's here. Look at the market on Friday, look at the market today, look at the market yesterday. Multi-100 point moves in the market. We should not be afraid of this, especially when you consider the strength of the U.S. economy and the fact that even the European economy and the Chinese economy is upticking slightly. So from a global growth standpoint, things are a little bit better. We believe that corporate earnings will start to grow, but at a modest, moderate rate. And that again reflects that the U.S. dollar is not such a headwind. It also reflects the fact that energy prices have stabilized, so it is no longer the drag that it once was on corporate earnings. Valuations in general are not cheap. Reasonable, but not cheap. Some could say it's stretched, but within the markets we see lots of opportunities. Current yields on bonds and cash appear to be unattractive. Earning less than 1% on an after-tax basis when inflation is greater than 1% is not a good investment in our opinion. So therefore, as we've said it earlier, our allocations to fixed income are modest at this point. Long-term investors should remain in the equity markets, focused on investments in solid companies with reasonable valuations. And that's our job, to make sure that you're invested in solid, high-quality companies with valuations that are reasonable. And you know that we look at this on a daily basis, and we look at your asset allocations on a quarterly basis to make sure if things have been very good, we make it more defensive in your allocations. If things are opportunistic, we should also be taking advantage of those opportunities. We remain committed to selective opportunities in real estate and private equity. And from time to time, we'll get an opportunity, and we will contact those clients that we believe are suitable for those investments to discuss them with you. And we believe that a prudent asset allocation with an overweight to defensive strategies is the best course for most investors at this point in time to endure the volatility and yet earn reasonable returns over the long term. And with that, I thank you for listening, and I'll turn it over to Karen for our Q&A period.
Brian, Ed, Bob, thank you so much for sharing all of this with our participants. We'll now begin answering questions from the audience. We received one question in advance, and we will take that back to We will take that as everyone starts to input their additional questions. So somebody sent a question earlier this week talking about that the Fed's accommodative policies of quantitative easing and historically low interest rates appear to be having less and less impact on our economy. They'd like to understand if there are other ways that the economy can achieve positive momentum in our opinion. And I'm going to let Phil take that one.
Thank you, Karen, and thank you for submitting that question. And I can certainly see why you feel that the Fed's actions are having less impact on the economy. We feel there are 2 or 3 additional things that can happen that can help the economy grow. The first is we believe that fiscal policy, which is stimulus through legislation, can be an important part of providing a lift to the economy. Both parties, Republicans and Democrats, are talking about infrastructure spending initiatives, increasing defense spending, tax reform, and the repatriation of foreign earnings. And we certainly hope that there will be a new era of cooperation between the parties that will see these plans become reality. Secondly, as we've been discussing, in about 4 months we're going to have a new president. And I think it's pretty evident that President Obama has supported an agenda which really hasn't been favorable towards business. The 2 candidates both recognize that for the economy to grow and be strong, we need domestic businesses to thrive, and their platforms and agendas will provide plans to address this. Additionally, consumer spending, which, as Bob mentioned, comprises about 70% of GDP, has been improving recently. The Commerce Department has reported 4 consecutive months of rising consumption by consumers, paralleling a rise in personal income. Should these trends continue, we would expect the consumer to help drive economic growth over the remainder of the year and into 2017. So between fiscal stimulus, a change in the Oval Office, and the reemergence of the consumer, we believe that our economy will continue to expand.
Great. Thank you so much for that. Hopefully that helped a number of our clients and people on the phone. Second question we just got is about valuations, which we've talked a lot about. So the question is that this individual has been reading that valuations are a concern in the dividend space. They're wondering if we find that, especially as we look at dividend growth, and if we are, how do we handle it?
I'd like to take that, Karen. This is Bob again. Our dividend growth strategy is predicated on a number of factors. 1, an above-average dividend, and 2, that the dividends will grow on an annual basis without over-levering the company, without robbing it of an opportunity to grow in the future. At the same time, we at First Long Island, our subcommittee that runs the dividend growth strategy, which consists of several of us, we have perfected, we believe, a valuation methodology that values each of the companies in our portfolio and each of the companies in our universe or bullpen of companies that we would consider for our dividend growth strategy. We are very mindful of the fact that dividend-bearing companies, especially those that grow their dividends, have been very much in vogue and have become investor favorites. But we utilize this very strict valuation methodology to tell us what is being undervalued, what is fairly valued, and what is somewhat overvalued. And what we typically do on good companies that become a bit overvalued is we shave them back, and we add those dollars to companies that are undervalued, or we find new companies that are undervalued. So we take very seriously the valuation of companies in every strategy, including dividend growth. So we will not own a company in dividend growth that has a good dividend and good dividend growth if it has become way overvalued. We will exit those companies or shave them down to a much smaller percentage. So I hope that answers your question. We do have a very strong valuation discipline in that strategy.
Thanks, Bob. That sounds like a great answer and should help our clients out a lot. We have also received another question from a client indicating that we've done well for their family and asking if we're currently accepting new clients. Ralph, you want to take that?
Yeah, I'll take it. Let me get close to the phone.
That's a tough one.
We have spent the last decade in building a very good investment team. We currently have 9 people on the investment committee. all of which were hand-selected by Bob and myself. And we feel very comfortable with them. The answer to the question is yes, we do have capacity, with the understanding that our minimum is $5 million, and we would love to have new clients. So if anybody out there has friends that feel would benefit from our services, we'd be glad to speak to them and give them the same help that we've given you.
Great. Thanks, Ralph. So I think that wraps up the questions that we've received thus far. I want to thank everyone for their time. On behalf of the entire FLI team, we hope you found this interesting and insightful and a good addition, especially for our clients, to the quarterly letter that we send to you. As Edward mentioned during his section, we will be hosting our next Thought Leadership Breakfast on Wednesday, November 2nd at the Garden City Hotel, where the topic will be Who Wins the White House in 2016 and What Happens Next. Invitations will be going out, and we hope to see you all there. For clients on the line, I'd like to remind you that our investment committee is always available to discuss your individual asset allocation. Please just give us a call. Thank you, and have a great afternoon.